Good evening, everyone. Thanks for joining. This is Market Making, and tonight we're just going to go through what I'm looking at before the open tomorrow morning. Um I think the real focus of today's episode, we're going to go through what's happening in Iran and potentially what is going on with this east-west pipeline that has just hit nameplate capacity in Saudi Arabia, where they'll be pushing 7 million barrels a day from the east of the country to the west and avoiding the Strait of Hormuz and finding their way through to the Red Sea, what that means for oil markets, and generally what that means for markets. So look, let's quickly just go through what happened in the market over last week. We closed the previous week, so the 20th of March, the Friday. We had the announcement that Trump was going to obliterate the energy sector in Iran if they did not open the Strait of Hormuz. So it was a very tense weekend. No one knew what was going to happen on the Monday. The Monday came and we had a classic taco, and Trump announced that he would not be obliterating Iran's energy sector. Rather, he would be giving them a 5-day extension on that promise. So, look, markets had a bid on the Monday. I think the S&P, the Nasdaq, they were all up from 1.5% to 2%. Stayed there for a couple more days, and then the market kind of realized, well, nothing's really changed. The Strait of Hormuz is still closed. Oil is still going higher. And bond yields, because oil is going higher and inflation is potentially becoming a proper issue that we need to look at, and potentially this is getting more of an entrenched problem like we saw in Russia and Ukraine during 2022. And we saw a big inflationary cycle and eventually a credit cycle that followed. Uh, People are kind of positioning themselves in front of that. They know the playbook, they know what's happened previously, so potentially this is something that they need to position ahead of rather than waiting for a few CPI and PCE prints. So we ended up on the week down. It was 2% on the S&P, to basically 2% on the Nasdaq, and year to date we're down 7% across both indices. I think this is an important market at the moment, the Treasury market. You are seeing yields continue to tick higher. 5 years, 10 years, both up 5%, 5 basis points. 30 years up 2. Year to date, we're up 30 basis points on the 5 year, 26 on the 10, and 14 on the 30s. If you're looking at markets at the moment and you're looking at any relations, you're going to see the relation to Brent crude or generally just crude, what crude oil's doing, what the energy market's doing, and it's having an effect on the treasury market. People know the play. People know that when energy prices are going up, there's going to be an inflationary cycle, potentially, if this issue does not get solved quickly, and people are positioning in front of any potential rate hikes that may arise from these issues in Iran. I think the US is probably the most insulated country when it comes to energy at the moment. They are energy independent, so to speak, much less like Australia, who is completely energy independent when it comes to fuel. Oh, sorry, energy dependent when it comes to fuel. They need to buy fuel from whether it be jet fuel, diesel fuel, or just generally LPG. They are buying that from Asia, Singapore, Thailand, China. They are buying fuel from these countries, Japan, and they are importing it, and they are having issues at the moment bringing the stuff in. So look, Brent crude is really the one that's driving the market at the moment, or crude in general. You're seeing crude push up treasury yields, and treasury yields are pushing down the effects of the major indices, which are also having margin squeezed here. If we do see an energy spike in the US, you're going to see, especially the tech sector, which is so heavily reliant at the moment on the AI build out, what that entails. Does this have an effect on the amount of capex that is going into this AI build out? It's just definitely something that needs to be considered when looking at this. Moving on, look, wheat is basically moving in lockstep with Brent over the past week, just to a lesser degree. Um, when there is an inflationary cycle, you are going to see people move to commodities like wheat, or generally just food commodities. Um, Wheat, I think, is a little bit more insulated from this crisis. It's very different to the Russia-Ukraine crisis, where I shouldn't say most, but a good portion of the world's food exports come out of the Black Sea. Um, the Black Sea, yes, is a major food exporter, and the Red Sea and what's getting produced in the Middle East. These guys are domestic consumers and consume basically all the grain that is produced domestically in the Middle East. They're net food importers. There is a global oversupply of wheat and generally a global oversupply of food. Um, so even though we're seeing a bit of a rally in wheat prices, it's just not going to be to the same degree as what you're going to see in oil markets. Iron ore is another one I wanted to quickly touch on. Look, iron ore market's been flat throughout the year. I would start getting concerned if we start seeing iron ore go lower. If iron ore goes lower, that's probably determined that so the how should I say this? The capacity for Southeast Asian and generally other Asian buyers of Chinese steel is starting to wane. It's having an effect on GDP, and generally the capacity to import steel to build out growth projects in that region is starting to wane. Um, China is now a very large and continues to grow in steel exports, and that if we do see that iron ore price wane, that is probably evidence that steel exports are suffering, prices are suffering, and the inputs that go into steel need to go lower. So yeah, something to consider. I think it's a slow mover, iron ore. I think the focus really needs to be on the Brent side of things, and it definitely will be this week. So look, it was announced earlier today that the East-West pipeline that Saudi Arabia have been talking about for some time has moved from a 3 million barrel a day program to about 7 million barrels a day, which is what is considered the max capacity of oil that can flow from the east of the country to the west, bypassing the Strait of Hormuz, which you can't really see very well. It's just here on this chart. Um, but yes, what it's doing is putting more barrels into the market. We did have another announcement over the weekend that the Houthi rebels that are in the south of the country in Yemen are joining the fight and joining the conflict, and they have sent missiles which were subsequently shot down by Israel. And they have threatened to block the Red Sea, which would block the potential exports of the crude that has flowed from the east of the country in Saudi Arabia to the west, and they would most likely have to follow their way through the Suez Canal and around the Cape of Good Hope, which would add a significant amount of freight costs to the price of oil that is flowing to Asia, which ends up being a very big issue for countries in the APAC region. Um, Look, so I wanted to run through the numbers, what we've got here. So This here, this 20 million barrels a day, this is the total amount of fuel, well, basically crude oil and refined products that have been displaced by the blocking, so to speak, of the Strait of Hormuz. So we got 15 million barrels of crude, 5 million barrels of refined product, which represents about 20% of total global oil consumption. Now, with an increase of the barrels that are flowing through this pipeline, as well as refined products, as well as other pipelines, including the Habshan Fujairah pipeline, which in the UAE bypasses again the Strait of Hormuz and goes through the Fujairah port. We've got about 7.2 million barrels a day that are now bypassing this 15 million barrel a day block. That's good. It definitely slows the pace of the price of a barrel of oil. I think I don't have the numbers in front of me, but I do believe there is a 5 million barrel a day cap on the exports that can come out of Yanbu. So even though we've got potentially 7 million barrels flowing from east to west, you still have a bottleneck at the port. I do want to bring up the numbers. So look, you've got 7 million barrels a day that are going to be entering the market. This is a best case scenario, so there still is logistics issues. We could still see Iran targeting this pipeline, which would be a complete disaster. These 5 million barrels a day above the 2 million barrels a day that are already flowing could see some issues if Iran were to target that pipeline. And then one thing we also have to consider is the price elasticity of oil, which is about 0.1 in the short run, I believe. So for every 10% that 10% that a barrel of oil goes up, about 1% of global demand drops off. This is in the short run. It is higher in the long run when energy consumers move to potentially different products. So oil's probably rallied in this crisis, I would say 50%. Let's just say call it 50%. Could be higher, could be lower. So 50%. Oops. What am I doing? 0, 50. Gone up 50%, so that represents a 5% drop in global demand for oil. Global demand, 100 million barrels a day, around there. It's actually a little bit higher, around 104, 105, so let's just call it 5 million barrels a day. If you add that onto the total bypass, you got 12.2 million barrels a day. So let's just bring that down here, a bit easier to read. 12.2, and our total crude oil gap is 15. So we are potentially getting to a point where we could see a top in this market. Now, I'm not a complete energy analyst. I'm not an energy trader. There are always issues when it comes to logistics and shortfalls in the market that you see squeezes in commodity markets against the paper versus the actual physical. And we could see oil continue to push higher, but I think we are slowly getting to the point now where oil is pricing at the correct level. I do expect us to get to the 120, 130 range, but this is the point where things start to break down. You do see more people enter the market. You do see more capacity come online. Potentially in the US, you could see more capacity come online. You will have, if we get to $150 barrel oil, you will have the 10-year will be over 5%. this is the thing. This is the point where things start breaking down in the market. But as it currently stands, all things running normally from here, we could start seeing oil start to cap out at 120, 130. Now, there is a potential ground invasion that could begin in Iran this week. If Iran feel threatened by this ground invasion, you're going to see them potentially targeting energy infrastructure in the Gulf. You've got to consider that this is potentially the life and death of the Islamic Republic of Iran. So you've got to put this into context where if Iran sees their backs against the wall, they will continue to target energy infrastructure and energy fields the in the Gulf, and that is going to continue to push up energy prices. If the US take Kharg Island, you're going to take a whole bunch of Iranian oil out of the global market. What's that going to do? That's going to push oil prices up. So in a vacuum, all things considered equal, we're getting to a point where oil is probably adequately priced, but we are in a war and things go wrong in war, if the Houthis close the Red Sea, that's going to add freight costs to this. What's getting exported from east to west and out of Saudi Arabia, they're going to have to go through the Suez, and they're going to have to come around the Cape of Good Hope to get into Asia. That's going to add on to the price of oil. Um, if you knock out Kharg Island, that's going to add on to the price of oil. If Iran target energy infrastructure, that's going to add on to the price of oil. So there's a whole bunch of things that can push oil higher, but at the moment we're kind of getting to that peak if everything is considerable stays as it is and the war doesn't escalate, so to speak. Um, so really, look, that is what I'm taking into consideration this week with the S&P where it is. A lot of companies that I wanted to buy in the US markets are approaching their 200-day moving averages and are getting to levels where I'd probably comfortable with getting into. However, I think my main focus this week will just be monitoring what is happening in the Middle East. Is there any signs of any further escalation? What is the crude price doing? Um, and then, yeah, whatever the crude price does is going to weigh on the 10-year, which is going to weigh on indexes and stock prices. So, yeah, I'll be keeping an eye on companies that I want to buy. And, yeah, hopefully we can make some money. Thanks, guys. If you do want to hear anything further from me in these episodes, I'm happy to go into them. I don't know if I'm going to do daily episodes at the moment. I'm happy just doing a weekly run through of what's happening in the market. But yeah, let's see how this goes, and I will see you next time. Thanks.